Despite rising inflation, major U.S. corporations are reporting record profits as companies pass rising supply chain costs on to consumers. Economics correspondent Paul Salmon explores whether concentrated market power is contributing to inflation.
Inflation. Everybody's talking about it.
Longtime liberal activist Robert Reich.
Corporations are raising prices even as they rake in record profits.
Prices at the pump have gone up. Why? Well, let me give you a hint.
Senator Elizabeth Warren.
This isn't about inflation. This is about price gouging.
This is a charge that pops up in lots of places, even on my Twitter feed. So, do the facts justify the outrage? Well, you've heard the standard causes of COVID inflation: government stimulus money, a tight labor market driving up wages, clogged supply chains, imports anchored offshore. And now, to top it off, Russia's invasion of Ukraine goosing oil, gas, and wheat prices. But if all this explains an inflation rate that's just reached 10% for businesses, the Producer Price Index, how come profits have risen even more?
Over the past year, companies' net margins have risen to record highs, and net margins are expected to rise again over the next year.
Wall Street Journal reporter Dion Rabowen.
Nearly 100 of the biggest U.S. publicly traded companies booked 2021 profit margins that were at least 50% higher than their 2019 levels.
And 2019 was pre-pandemic. The economy solid, inflation low. So why the profit hike?
The CEO of Kroger recently said,
"A little bit of inflation is always good in our business."
Lindsay Owens runs a progressive economic think tank that scours the earnings calls corporations hold for stock analysts and investors, like this one from Constellation Brands, which sells beer, wine, and spirits.
We're going to look at this on a market-by-market basis, brand-by-brand basis, and we'll take as much pricing as we think the consumer can absorb.
one of my favorite examples is Tyson Foods.
Purveyor of 1 out of every 5 pounds of beef, chicken, and pork sold in the U.S. Here's Tyson's chief financial officer on their latest quarterly results.
Our pricing actions led to approximately $2.1 billion in sales and price mix benefit during the quarter, which offset the higher cost of goods sold of $1.6 billion.
In other words, says Owens,
Our pricing is taking into account the cost of raw materials and the cost of labor, but more than offsetting it. And that more than offsetting it is that additional profit that they're able to bring in.
but profits sank when COVID hit, say companies like Tyson. This is just making up for lost time. Nothing but an extreme, short-term business cycle.
Capitalism requires greed to run.
Economist Noah Smith.
Corporations are always greedy. Their greed dial is always set to absolute maximum. And the idea that ameliorating greed would have any effect on inflation is wrong. And I made fun of it by making the following chart.
Smith, a liberal, mocks the idea that newfound greed explains the inflation surge with a tongue-in-cheek greed index chart.
And I labeled the rises in inflation as rising greed and the drops in inflation as falling greed.
Which would imply rising corporate generosity.
The reason this is a joke is because the big drop in inflation in the 80s would have to be caused by surges in corporate altruism, the altruism of Gordon Gekko and the 80s people.
Greed is good.
Yes, that Gordon Gekko.
Greed works.
So back to the original question. If corporate America is no greedier than ever, how come profits have soared?
What we're seeing in this moment is really when that profit maximization and opportunity collides. And the opportunity is the cover of inflation.
Aha, the opportunity caused by the pandemic. And when companies like Tyson blame higher costs, as their CEO has?
Labor costs have been up 20%, cattle costs are up 22%, and freight is up 32%. We're not asking customers or the consumer ultimately to pay for our inefficiencies. We're asking them to pay for inflation.
Woe is me. We have no choice but to raise our prices. Our labor costs are going up. Our inputs. But in reality, companies aren't being forced to raise prices because of inflation. They're raising prices because they can.
And why can they now, with so little resistance, I asked Rabowen.
Inflation sort of disguises these price increases. When prices for everything around you are rising, it's much easier for companies to raise their prices and not experience that consumer blowback.
The point is, when consumers come to expect inflation, the process can begin to feed on itself.
Companies know that consumers expect higher prices right now, and they're really seeing how far they can push that.
And says Robert Reich, Wall Street is egging them on, saying,
look, this is a great time to raise your profit margins. And of course, those Wall Streeters are saying the same thing to everybody else in the industry.
But in a competitive market economy, won't newcomers emerge offering lower prices? That's a lot less likely these days, say Rebowen and Reich.
75% of all American industries have become more concentrated in the last 2 decades.
Most are now dominated by a handful of corporations that coordinate prices and production. This is true of banks, broadband, pharmaceutical companies, airlines, meat packers.
You got 4 basic meat packing facilities, and you pay a hell of a lot more because there's only 4.
Now, it's not literally just 4, but 4 do dominate the market. And it's not just meat.
See what's happening with ocean carriers. During the pandemic, about half a dozen foreign-owned companies raised prices by as much as 1,000% and made record profits.
The traditional check on consolidation, of course, is antitrust enforcement. Reich worked at the Federal Trade Commission in the 1970s.
Antitrust used to be a real thing. But since the early 1980s, antitrust has taken a back seat. In fact, some would say it's been thrown out of the car altogether. And big companies now routinely have the power to raise prices. Customers will note that there is almost an exact price matching among all major so-called competitors because they're not really competing.
So what is to be done?
Tonight, I'm announcing a crackdown on those companies overcharging American businesses and consumers.
A crackdown on the shipping industry by regulators.
If they identify that there is market manipulation or price gouging going on.
The president's national economic advisor, Brian Deese.
And the agencies have now committed to partnering, where the Department of Justice has significantly more enforcement resources and investigatory resources.
And the administration says it's working to lessen concentration in the food sector, too.
You need scale to be competitive, and it takes capital to get to scale. So the USDA is actually right now working with smaller processors in rural areas across the country to try to give them grants, give them low-cost capital so that they can scale, they can get into the game more quickly and easily.
As the meat industry points out, though, it's been concentrated for decades. Decades of low inflation, even in meat. In the end, this is any administration's challenge, to effect real change amidst economic forces bigger than any of us. Meanwhile, with company costs rising at about 10%, corporate profits are rising at 12.4%. That extra 2.5% or so seems to be at least part of the inflation we're all paying for now. For the PBS NewsHour, Paul Salman.